Good afternoon and welcome to Scotia iTRADE's webinar. My name is Conleaf, the Client Education Specialist with Scotia iTRADE. I'm pleased to present to you today Options Fundamentals with the Montreal Exchange. Before we get started, let's take care of some housekeeping items and then we'll jump right in. So your sound quality should be good. However, you can check this quality of sound by clicking the sound check link in the audio panel of your GoToWebinar toolbar. This setup window may be on your secondary screen if you're using two monitors. Please be reminded that everyone will be muted for sound quality purposes today. Now, if you're using your computer audio and you're experiencing sound quality issues, you may wish to switch to telephone and call us via the conference number on your toolbar. Just don't forget to use the access code and your audio pin ID. I have a quick disclaimer which I'll just read quickly for you. Unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, which is collectively called the content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products, third-party content, or investment loss arising from the use of this content, including third-party content. So the information that we're presenting to you today, it will be only for educational purposes only. Just keep that in mind as we move forward during the presentation. And further to that, the options, just keep in mind, options do involve risk. They're not suitable for all investors, and they are intended for sophisticated investors. So before trading options, please carefully review the options account agreement contained in the Scotia iTRADE relationship disclosure document and terms and conditions. This can be found in our forms library. Just go over to the scotiaitrade.com page under any one of the tabs, go to the forms library, and you will find this disclosure document located there. Or just email me at scotiaitrade.com, or sorry, education@scotiaitrade.com, and I'll be able to provide you a copy of that. So let's just quickly now review the toolbar. The orange arrow that you see at the top of the toolbar can be used to minimize or to maximize the GoToWebinar toolbar. You can also view the presentation in full screen mode by clicking on that computer icon you see on the toolbar. In addition, the hand icon can be used if you've got a question or a concern. You can raise your hand by clicking on that icon. Preferably, though, we would prefer you to use the question panel box to type in your question, and then I'll be able to monitor those and interact with you that way. So today's session will be recorded. We'll then be emailing you a link to the recording. Actually, I'm going to have to just back away from that a little bit. I won't be able to email a link of the recording due to some of the regulatory concerns that have just been put in place. So what I would prefer you to do is to visit our YouTube channel, Webinars on Demand playlist, to get a copy of that recording. If you want a copy, you can also email me at education@scotiaitrade.com, and I can respond back to you via email. So just keep that in mind. I will only be able to send an email to those who have expressly consented to receiving email documentation. There's a new law that's been put in place, so just keep that in mind. Now we're going to be providing you a copy of the PDF for this presentation at the end of the session. In the GoToWebinar toolbar, you'll see the handout menu. I'll be uploading a deck to that for you at the end of the session. So just keep in mind when we finish, I'll prompt you, give it 30 seconds or so, and you'll receive a copy of the PDF deck for this presentation for your review going forward. So today's session, the Options Fundamental, provided by the Montreal Exchange, is a part of a learning series that the Montreal Exchange provides. As you can see on the page here, there are 5 series in this particular one. We're currently on the first series, the Getting Started with Options. Today is the Part A, Options Fundamentals, And then going forward over the course of the rest of the year and next year, we'll go through the remainder of the series. So just keep in mind, take a look on our events calendar for when we're presenting the follow-up to this options series. It's very interesting. Our presenter today is Patrick Seresna with the Montreal Exchange. Patrick is the founder and chief derivative market strategist at Big Picture Trading, Inc. He's he's a chartered market technician, a derivative market specialist, and a Canadian investment manager by designation. In addition to Big Picture Trading, Patrick is an instructor on derivatives for the TMX Montreal Exchange. He educates investors and investment professionals across Canada about the many valuable uses of options in their investment portfolios. He also co-hosts on the macrovoices.com, one of the prominent financial podcasts on the market today. So as you can see, Patrick is extremely qualified and very knowledgeable, and will be able to provide some valuable information today. So what you can do then as we go through the presentation, if you've got any questions, just type them into the question panel box. Most likely we'll be leaving some time at the end for a Q&A session with Patrick, but if the question concerns something extremely urgent, I'll be able to provide that over to Patrick as well. So use your question panel box as we go forward today. But without further ado, what I'm going to do now is pass you over to Patrick, who will then be facilitating the session. Patrick?
Well, thank you very much, Conliffe, and hello, everyone, and thank you for joining us. Thanks for that introduction. And well, we're starting off today at the beginning of this series. Let me just quickly share the screen that will have the title on there. Perfect. And so we're starting off this session right from the very beginning, and that's the option fundamentals, like what is an option and how it works. And I happen to be very passionate about the use of options. Now, as always, brokerages require the disclaimers to be put on there about the risks associated with options. But I want to share with you my perspective in the more neutral way that I look at options. I've always taught and I've always explained that to me options are a tool. And the tool can be used to generate income, the tool could be used to protect a portfolio, but the tool could also be used to attain very high levels of leverage. And of course, when somebody new uses that option as a speculative tool to attain substantial amounts of leverage, they could also result in a substantial loss. And so everyone hears the stories of someone that's hurt themselves with options, but what I encourage all of you to do is look at options for what they are, rather and try to understand how you can use them as a tool to help you achieve all sorts of different amazing things in your portfolios that are beyond the traditional buy and hold stock style investing. Nonetheless, we're going to focus today at keeping it right at the introductory level of understanding how these options work. You know, and of course, everything that we demonstrate in this presentation is for educational purposes only, just the traditional disclaimer. And so we're going to cover everything from what is an option, looking at options chains, pricing variables, looking at everything from intrinsic and time value, and this idea of exercise and assignment. We're just going to go into the very nature of how these options work right from the beginning. And so options are a derivative, are part of the derivative market, and almost anyone that's heard the word derivative associates it with something like the financial crisis in 2008, and you hear the stories of you know, the idea that you know, mortgage-backed securities and the CDOs and all of these other types of derivatives that caused there to be substantial meltdowns. But options are a little bit of a different style of derivative. It's a contractual agreement within two counterparties, but done through the exchanges rather than the risky over-the-counter markets where most of the derivative world has the trillions and trillions of dollars of exposure. So now, These derivatives are called derivatives because they attain their or acquire their value from an underlying security. What in not so many words, is that when you, let's say, have a call option on Suncor, the price of that call option is derived from the actual price of Suncor shares. So the option is a derivative of the shares, and that's why it's considered a derivative. And every options contract represents rights and obligations. It is structurally different than the futures market. A futures market, the buyer and the seller within futures both have obligations to do business in the future at a specific price. Options are one-directional in a sense that there's a buyer and a seller, which we'll talk about, and in fact, I'll just demonstrate it here. There's a buyer and a seller of these calls and put options, and each have a different right or obligation. The buyer has a right, the seller has an obligation. I will explain this in great detail with lots of examples. So if it's a little bit overwhelming right off the bat, I promise you we'll break it down to the most straightforward concepts. So there are two types of call options. Two types of options: call options and put options. A call option is a right to buy. A put option is a right to sell. And so there's two types of options because there's two types of transactions. There's a buy transaction and a sell transaction. And so there's calls and then there's puts to represent each one of those. Now, the rights and obligations are dependent on which type is chosen, whether you're the buyer or the seller of a contract. And so no better way to do this is to explain it through an example. So what the next, well, I'll get to an example right here in just a moment, but there's a few particulars or specifics that I want to clarify for these these are not over-the-counter, sorry, the exchange-traded options. First of all, for the vast majority of products, each option controls 100 shares. So if I bought 10 call options, I'm controlling 1,000 shares. If I bought 7 call options, I'll be controlling 700 shares. Now, just like when you see a quote on a stock and you say, what is Google trading at, or what is Microsoft trading at, you're seeing a quote on a per share basis. One share of this company costs X number of dollars. Options are also quoted on what the option price is per share, but because each option represents 100 shares, you have to multiply it by 100 to know what it's worth. So when we look at an options chain, and let's say we're looking at the options chain for shares of Bank of Nova Scotia, and let's say the stock was trading at $50, and you see that the call option on BNS is trading for $1.25, then it's $1.25 per share. But to buy one call option, you're controlling 100 shares, so you're going to do the $1.25 times 100, which basically means it would cost you $125 to buy one call option to control 100 shares of the stock. And so just it's quoted per share, but you can't buy half of an options contract. You can't control 50 shares. You cannot control 25 shares. It's always in these 100 share increments, and from that perspective. So an option or a call option is a contractual agreement between two counterparties, a buyer and a seller. This is the very most important element of options. There must be a buyer for every seller. There are two counterparties. When we get into more advanced sessions throughout this series, what you will find is that there's all sorts of strategies for the sell side or the buy side, and price discovery of options prices are all dependent on where the equilibrium between buyers and sellers are. The key thing is that there are two very specific sides. The call buyer is the way that the vast majority engage in options at the very beginning. They just simply buy a call instead of buying the stock. Now, the best way to kind of illustrate this is an example that has nothing to do with stocks at all. So let's, I just would like to kind of go a little bit off on a tangent and just kind of explain a contractual agreement between two people that may want to do business in the future. And so something that all of you will have probably done in your lifetime was buy or sell a car. And so let's just say that I was having a conversation with Conliffe before we started today's session, and I told him I was thinking about selling my car. And you know, earlier when we met, he liked the car and everything, and he's interested. And so Conliffe says to me, Patrick, what are you thinking of selling that car for? And I would say, I'm thinking of selling for 20 grand. Immediately Conliffe thinks, well, you know what? I've seen those cars listed for $22,000 to $25,000. I think he's totally pricing it too cheap. So now most of you know how this transaction gets done traditionally, which is he will turn around, write a check for $20,000. I'll sign the back of the ownership papers, and we'll exchange the car outright. And he undertakes all of the obligation of owning it because he owns it. Now, that is a spot transaction. That is a transaction that is conducted on, and that is the way we buy or sell shares. So if you buy Suncor shares or Tech Resource shares or shares of Bank of Nova Scotia right now, you are physically exchanging at the spot rate the actual price of the underlying. But now Conliffe is a smart guy, and he turns around and says, you know what? I think I can flip this for a good profit, but I'm going to make Patrick a good offer. So he turns around and says to me, Patrick, I'm going to make you a deal. I'll pay you $500 if you give me the right to buy your car off of you for $20,000 over the next 1 month. In doing so, you have to guarantee me that you won't sell it to anyone else, that you're going to sell it to me for $20,000. I have a month to decide, and you're going to guarantee me the $20,000 price. To me, that sounds like a pretty good deal, because to me what that's doing is it's essentially I was going to sell it for 20 grand. Now I could make $20,500, and I'm making an extra $500 income. So I say you got a deal. So now what's happened is I'm the seller of the option. I've basically turned around, and Conliffe takes $500 out of his pocket and gives it to me into my hand, and we have now created what's called an over-the-counter option on that car. In the end, if you look on the left-hand side, the call buyer, Conliffe has the right to buy that car at a specific price of $20,000 over a specific period of time, which is 1 month. I, on the other end, am the seller of the option. I got paid the $500 income. Now it comes to, well, the income strategies you can do with options for having the obligation to have to sell the car at $20,000 over the next 1 month. And the two counterparties have made a deal. Understand, an option cannot come to existence without two counterparties. Often, market makers will play the role of that counterparty because options are fungible and interchangeable. You might buy it from one person and sell it to another. That's what makes an exchange-traded option so unique. But there's still that's where open interest comes into existence. You might see 1,000 contracts open interest. It literally means 1,000 contracts worth of investors shook hands and created this deal between the buyer and the seller to do business in the future. So now let's do an example here with Jackie. She turns around and she's bullish on the shares of XYZ, and she does not yet own the stock. And she's looking for a risk-managed way to participate on the upside, believing that the stock is going to go higher. So she's thinking of buying the shares, but she's also considering using an option as an alternative way to participate on the upside of the stock. Now, alternatively, we have Peter. Now, Peter actually physically owns the shares of XYZ. Now, there are option strategies where people could sell call options and not own the stock. But for the sake of this example, work with me on this, that Peter physically owned the shares. And he physically owned the shares and believed quite opposite to Jackie, that there's only a limited upside on the stock. And is saying, well, look, while I own the shares, if the stock doesn't go higher, I can generate an income off of the shares I own, and so I'm willing to sell the options and be the counterparty. And so in this case, Jackie and Peter, through the exchanges, engage the market, and will turn around, and Jackie will buy call options, and Peter will be the seller of the call options. And so in this scenario, let's say XYZ shares are trading at $105 per share. And so you can see a 1 month $105 call option is trading for $1.40. So remember, what would we have to do? For 100 shares, which is one call option, you would take the quoted price of $1.40 per share times 100. It's going to cost Jackie $140. And notice the difference here. If Jackie chose to buy the shares and wanted to buy 100 shares of XYZ, Jackie would have had to pay over $10,000 in cash to be able to control 100 shares of the stock. Alternatively, with just a $140 call option, Jackie doesn't have to own the shares yet. She has the right to be able to buy the shares at 105, but does not yet own them. So she's synthetically controlling those 100 shares of this XYZ stock, and it only cost her $140 to do so. So now Peter receives the $140 income and has an obligation to have to sell her the shares at 105 if she wanted them. So that's how a deal is struck between two counterparties. Now you'll see some options are very cheap, others are very expensive, because the market adjusts for the implied volatility of a stock. So for illustrative purposes, I'll say that, for instance, Teck Resources in Canada is an incredibly volatile stock. Its implied volatility can hover over 40%. On a regular basis. What you will see is the call options are relatively expensive. Alternatively, you take a very low beta stock like BCE, and what you'll find is, with this implied volatility very low, it's actually relatively cheap on a comparative basis to buy a call option on BCE. And so the marketplace adjusts based on probability. That's the whole theory of option pricing, something that we get into in later programs. But this very essence right here is just the idea of how one of these contracts comes into play. Now, there's a second type of an option, which is called the put option. And the put option is actually contractually in almost every way mathematically calculated the same way as the call option, with one very, very, very important difference. And that is, notice that for the put option buyer, it is the right to sell, not the right to buy. Remember, a call option is the right to buy the security at a specific price. A put option is the right to sell it at a specific price. This is where in future presentations, when we get into the concept of buying puts as protection, and what we're doing is, by buying puts as protection, you're securing the right to sell. You can literally buy the put like an insurance policy on your stock and guarantee yourself a sale price. And so in this scenario, you pay the put buyer secures a specific price they can sell at over a specific period of time. And now this is the interesting part. Some people buy that put option as protection. Others will use the put option as a speculation on believing that a stock is going to decline. By buying a put option on something that you don't need insurance on, let's say you're buying insurance on something you don't own. If something happens to that price, then you're cashing in the insurance. It's like buying life insurance on your buddy when he's going skydiving. It's a bad example, but in the end, you're buying insurance on something that is not that you own, and you could therefore speculate on the decline of something during that period. At the same time, somebody has to be the counterparty to that. If if in this example, Doug, who's buying the put option here on the left-hand side, well, there has to be a counterparty who will undertake the obligation to have to buy that at a specific price over a specific period of time. Then what happens is the money that that one person on the left pays, the counterparty is paid the premium as income as the counterparty. So you can see, and they both have to exist. There has to be a buyer for every seller, and there has to be a seller for every buyer. It's a zero-sum game that way in that market. Now, by the way, when I say the word zero-sum game, I do want to stress one thing: is that if you feel that the seller has the strategic advantage over the buyer, then you have the ability to be the seller as a retail investor just as easily as you can be a buyer. I want to emphasize that, you know, this is not like some black curtain thing where all retail investors must be buyers only and the sellers are these market makers behind black curtains taking advantage of the buyers. No, in fact, if you feel that the option is too expensive and it is likely to expire, you can profit from that by being the seller of that option and being the counterparty, and the market, you're free to function within the options market that way. And there's at Scotia there are different levels of option approval, and so not everyone at the beginning can maybe start off there, but it is available to retail investors, and it is something that you can explore as you go through. So let's look at this scenario. In this scenario, Doug is bearish on ABC stock, does not have a position yet, and is looking for a risk-managed way to profit from the decline. And so alternatively, Amy actually physically likes those shares of ABC stock and believes there's only a limited downside risk to the stock on the short term. So Amy is looking to make some income off of selling put options to generate cash flow. I always like to equate this relationship between the buyer and seller in options very similar to that of buying car insurance. Now, the time decay on car insurance is different, but what you want to think is that when you pay money, a premium for your car insurance, you're paying that premium because you want to have the right that if you total your car or damage it, you have the right to sell it back to the insurance company at its, let's say, book value over the next 1 year, if that's you know what time frame you bought your insurance for. Alternatively, the insurance company received the income and undertook the counterparty obligation of that car insurance, right? And so that's the way that market works. So in this case, Doug and Amy came to an agreement to do business in the future. So an example here, ABC stock is trading at $22 a share, and a 1 month put option in this case might be trading at 20 cents. So literally in this situation, rather than, let's say, Doug short selling $2,000 of ABC stock for 100 shares, Doug can turn around and pay $20 for a put option that has secured him a right to be able to sell the stock at $22, let's say, over the next 1 month. Amy, on the other hand, turned around and made the $20 income for the obligation to have to potentially buy that stock at $22. And this is how we come about to make a market within the options market. So notice that there was two very specific details to the option, and that is there was a strike price, which is the contractual obligation from which you have the right to buy or sell the option. And so in the case, let's say, let's hypothetically say Tech Resources, let's just actually see it. So let's just say, like right now, Tech Resources is trading at $25.92. If I turned around and bought a call option at the $25 strike, what I'm doing is I am securing a purchase price at $25. Now the stock might go to 28, it might go to 22, but I have secured a contractual right to buy the stock at a very specific price that does not fluctuate. That price I've secured with the option was to buy, let's say, Tech Resources at 25. You actually can very specifically know what price in the future you have the right to buy the underlying stock. Now, while you can secure a specific price, you have that right to be able to buy it for a specific period of time. So you may buy a 1-month option, a 3-month option, a 1-week option. There's all sorts of different durations. And you buy it, and that's where you have the contractual right to be able to do so. And so there are a very large amount of monthly options. That's the original option. Today there are weekly options. I'll get to that in the next slide. But monthly options, which occur on a regular sequence on a quarterly basis outwards. So you'll have options that, let's say, January, April, July, October, you'll have a sequence of options available, and each one of those options expires the 3rd Friday of the month. And so you literally would take a calendar. So for instance, for the month of August, the 3rd Friday already passed in July, it was last Friday. But if we took a calendar, then the very first Friday of August is the 4th of August, then there's the 11th of August, and then there's the 18th of August, which is the 3rd Friday in August. So by just simply looking at calendar, we know that the option expiration for the August options falls upon the 18th of August. It's always the 3rd Friday of that month. Now, it's, of course, that's unless it's a weekly option. Now, it used to be quite simple with monthly options, and you just knew that every 3rd Friday. But due to increasing popularity, there's a very large amount of traders that enjoy trading very short-term options. And this brought about the creation of weekly options. And they're only really available in Canada on the most liquid stocks, so all the bank stocks and all of those kind of, Suncor and all the other big names will have all the weekly options. They're listed always on the Thursday and expire the following Friday. And so you have these very short-term options. So you could buy insurance or the right to buy or sell a stock and go even 1 week out and have the right to buy or sell over the course of a week. And so those people that are seeking very short-term leverage or short-term risk-managed way of participating in a stock can always turn to these weekly options as a mechanism from which they can enter the markets. Now, back to those monthlies, like I was referencing earlier, each stock is assigned a different cycle. Obviously there's only 3 cycles, but the reason they did this is very simple. They didn't want the golf ball and the garden hose kind of effect where if every single stock had an April option out, then that means every April and July would be incredibly important, as almost every stock in the stock market has this big monthly expiration coming to it. So what happens by staggering stocks between the 3 cycles, it tries to distribute the entire stock market equally to each month. It was at least the way it was done originally. Obviously now with weekly options, it really is all very much every single expiration is an important expiration. But you will still see some stocks, for instance, you'll see that you have a choice of a November option, but then you'll go to another stock and they don't have November options, they have December options or October options, but there is no November. It's all because each stock might be assigned a different option cycle. It's just the reality of how the options market works. Now, there are 2 styles of options, American style and European style options. Now, the first thing I wanted to actually just to deviate off and very clearly point out, there is a bid and ask on an option all the time. Market makers are making a market on options no different than their market makers making bid and asks on stocks. The market makers are out there, which means that you can buy an option and tomorrow sell the option. In fact, you can even sell the option 5 minutes after you bought it. A lot of traders, if you are a trader using technical analysis, a lot of traders often will use short-term technical analysis to buy an option, participate in a particular move in a stock, and later sell the option, never taking the ownership of the stock. Remember at the beginning I'm explaining, well, it's about this idea that you're securing the right to buy or sell in the future. Well, yes, that's what makes the option have a value, but what happens is that because the options market is liquid, a lot of traders like to actually trade options. They'll turn around and buy an option, later sell an option, or combine options to do more advanced strategies such as combinations. There's all sorts of different things that you can do on that. But the one thing that you want to anchor yourself when there's a reason we're calling today option fundamentals, because fundamentally the reason the option has a value is because you have the right to buy the shares. This is very important, because otherwise, how is there a value assigned to what the option is worth unless that contractual right is actually inherently in there? And so even though you may be joining us today in this webinar to learn about how to buy low, sell high with just the options as a trading vehicle, you need to understand the fundamental of why that option has that value. Why is it worth what it is? And then it comes back to this core understanding of your rights and obligations. And so nonetheless, the vast majority of stocks and exchange traded fund options are what are called American style. Now that means the buyer of the option has the right to be able to buy the stock anytime they want. So even though in that earlier example it was a 1 month call option, in theory, Peter in the earlier example, or sorry, it was Amy, or no, sorry, it was Jackie in the earlier example that had the call options on XYZ. She theoretically, a day after she bought the call option, could call up, in this case, if you have your Scotia account, you would call up the options desk and literally give them the instructions that you want to exercise your right to actually physically buy the shares. You don't have to do this, but you have the right to do this. And what you can do is anytime you can give them instructions, and literally overnight the clearing corporations will settle the options, and you will physically see the shares appear in your account at the price of the strike price of the option. So for instance, if you bought a call option in Tech Resources at $25 and Tech Resources jumps to $30 a share, you can call in and say, I want to exercise my right to buy the stock at $25, and then next day the stock physical shares are in your account at $25, even though the stock's at 30. You have the right to do that. Now, there's usually no real incentive to do that because the price of the option is accurately pricing the value, but you have the right to do that. That's what creates accurate pricing of the options market. And of course, the seller of the option has the counterparty obligation to have to deliver if they're assigned on those shares. And so in this case, Jackie originally bought the $105 call options for $1.40. The XYZ proceeds of the rally, it was to rally to, XYZ then proceeds to rally above $105 come expiration. It could be 110, 107, 120. It doesn't matter what price. It just is above 105. And so in the end, Jackie could just sell the call option at a profit. So let's say the shares of XYZ are trading at $108. Well, in theory, you know, Jackie bought the call option for $1.40. She could turn around and sell it for a $3 intrinsic value, which would be what the market on the option is. If you don't understand that yet, that's okay. We didn't cover intrinsic value yet in the presentation. But I can assure you that she could turn around and flip it for a profit. Now, alternatively, she can just not take profits on the option and physically exercise her right to buy the shares. So the transaction would involve Jackie literally sending the money to Peter, and Peter, therefore being assigned, has to deliver the shares at the $105 price. You literally, physically, will see shares transacted in your account. And so that is something that you have to be aware of. That you have the right to be able to do. Now, again, you don't ever have to transact. This transaction of sending the cash for the shares does not have to occur. Like I said, traders can physically buy a call and later sell the call at a profit or a loss and never have taken ownership of the shares. But they had the right to do so. Right? And so you have to ask yourself, do you want to trade the option or do you want to use the option as an investment tool? Right? And so now there is a safety net within there. A lot of people find this intimidating, but think of it this way, that it's a self-protection mechanism to ensure that you get what you're deserved. What happens is that if an option has an intrinsic value, we'll talk about intrinsic value in a moment, of at least 1 cent, that we use the terminology in the money, which is essentially means that in this case, any price that is at 1 cent above $105, right? So Jackie had an option that had the right to buy at 105. If that option was even trading at $105.01, sorry, the stock was trading at that price, and you held it right till its expiration date, and it's 4 o'clock on that Friday of the monthly expiration, only when the option is about to cease to exist. If you do not give instructions otherwise, the clearing corporation will assume you physically wanted delivery on the shares. For most people, this is fine, but where the speculation comes in that might be tricky here is that you can buy call options in your you could buy call options in your tax-free savings account. So imagine you have an investor with $20,000 in their tax-free savings account, and you buy call options. If your obligation to, let's say, buy is $30,000 or $40,000 of stock, but you only have $20,000 of cash, there's a problem. Because you're not allowed to borrow on margin in a tax-free savings account. This is where the credit departments at the different banks will have to will address to you your situation at that time. Now, this is only ever triggered at the market close on expiration, and it's the Canadian Derivatives Clearing Corporation that assumes that the option holder wishes to exercise. If you did not want the shares, you have two choices. You can go and sell the option on the market, or if the option is worth so little money that the commissions would be too big of a burden, you can literally phone into the brokerage and give them instructions, say, I am choosing not to exercise and renege on this option, and they will tell the clearing corporation not to settle it. So there are all sorts of things you can know, but you just need to know what you have in your account and take some action accordingly if you're at the money. Now the implications: call buyer, the underlying purchase of the is at the strike price or higher. Put option, the underlying will be sold at the strike price or lower, and if the put holder does not already own the underlying position, a short position is created. In other words, you could actually often buy put options as a synthetic short sell and then use it to actually exercise your right to short sell a stock. Now, obviously, there has to be enough inventory and other little logistical things that you'd have to deal with the brokerage on, but some people will use this as a way of short selling their stocks. Now, I would argue as much as 99+% of options are American style, but there are European style options as well. And European style options are predominantly reserved for either over-the-counter transactions or index options on an index option. Like, for instance, if you bought an option on the TSX 60, now you could, we're not talking the exchange traded fund like the XIU, but the actual index itself. Well, what if you exercise, what would be delivered? All 60 shares in the index. In the end, what happens, there are certain indices that need to be cash settled because actually physically transacting shares is just too impractical. It's too difficult. And so essentially what they've now do here with European style is you could buy the call option, sell it anytime you want the same way, following all the same rules, but the difference is that it can only physically be exercised on its expiration, and on its expiration it's only settled for cash. In other words, no physical shares are transacted back and forth. A lot of advanced traders like these European style options, such as the S&P 500 index or the SXO, the Canadian TSX 60 index, because by being European settled, when they're doing advanced option combinations such as spreads or butterflies or other things like this, they know that they're not going to get exercised early on one leg of their trade, and a lot of them like it this way. Nonetheless, it's overall, think of it this way: at the beginning stages, you'll almost certainly be predominantly in the world of American style options, because many of you that, let's say, will trade the TSX 60 will do so with the iShares Exchange Traded Fund, the XIU, rather than the actual index. And so that, because it's an ETF, it's American style settlement. And so most of you that use options will tend to be exposed only to the American style. Now, the option pricing is based on the following variables. You have the pricing, the price of the underlying, the strike of the option, how much time there is until its expiration, the volatility of the underlying, the dividend, and the rate of interest rates. When you know all of these things, you can compute the theoretical price of an option. It's all mathematically derived based on probabilities. And these are like an algebra equation, and these are all the math components that go into determining the price. Now, you've heard me use the term earlier, this idea of in the money or at the money or out of the money. These are just financial jargon that we use in this industry to define where the stock price is relative to its strike price. This varies throughout the life of the option. So let me give you an example. Something that many of you may be familiar with, and that's the purchase of a new home from a new home sales place, right? So you walk into a place and they're asking for a $20,000 deposit on a new home, and that you, let's say, when the property is finished a year from now, which you have the right to buy it at, let's say, $500,000. Not right, you have an obligation to buy it at $500,000. But now, during the year, while you're waiting for your home to increase or decrease, the price may go above or below the price you've agreed to buy it, which is $500,000. Suddenly, if the real estate market is hot and it goes to $550,000 for the average home, you have the right to buy it at $500,000. That means that you're in the money by $50,000. If there was a very steep market correction in real estate and prices dropped to $450,000, suddenly you're out of the money because your obligation is to buy at $500,000, and the prices are trading at $450,000. And so what we're doing is using the terminology in the money, at the money, out of the money as our way of differentiating where the price is relative to the contractual price which on the option. Now, when something is in the money, the option builds what's called an intrinsic value. And this is where it's very important for beginners to look at, because when they look at an options chain, they'll see this one option's worth 25 cents and this other option's worth $4. They immediately equate that the 25-cent one is the cheaper one and they're getting a better price, while the $4 one's too expensive. But you don't want to look at it that way. You want to understand where the intrinsic value in the option is on a relative basis. And so the other component of an option is time value. And time value is the premium that you're paying, like almost like an insurance policy. You pay a premium for the contractual right or obligation, and the time value, as time passes, erodes to zero. It's going to have a zero expiration, and so time till expiration decays. And this is the time is a function of unpredictability. Like, for instance, if, let's say, Tech Resources today is trading at $26, if I told you that it could go to 30. But now, if I told you it was going to go 30 in the next 1 month, or if I told you it was going to go to $30 in the next 6 months, which one has the more probable scenario of happening? The one over 6 months. So what happens is the option has to be much more expensive for 6 months of time, and so time decays in its value while you're in it. And so when you look at a quote, we'll talk about how to calculate intrinsic value, but let's say we have a stock that's trading at $20 and you own a $15 call option, right? So now think of this. A $15 call option gives you the right to buy the shares at 15, but the stock's trading at 20. So you can immediately buy it at 15 and flip it for 20 if you wanted to. But so there's what we call a $5 intrinsic value. But yet when you go into the market and you go to the exchange and you see with a quote on the price, you'll see that the quote is quoted at $6.50. So what you want to think is that the $6.50 quoted option is $1.50 of decaying time value. It's the option premium, and $5 of intrinsic value. Recognize that that's like literally buying $5 of the stock. And understand if the whatever, let's say this is a 3-month option, if 3 months pass, well, the $1.50 will time decay to 0, but your $5 intrinsic value is still there because the stock's at $20 and you have a right to buy it at 15. You can immediately exercise your right to buy it at 15, flip it for 20, and there's a $5 gain. And that's the $5 intrinsic value that has to be priced into the option the whole time. Now, just to clarify, not every option has intrinsic value, but the ones that do, you have to calculate it by looking at the difference between the stock price and the strike price of the option where you have the right to buy it. Now, put option is the same thing, but the reciprocal. The reciprocal because it's a right to sell versus a right to buy. So in this situation, you may own a $25 put option, and the $25 put option gives us the right to sell the stock anytime we wanted at $25. Now, the stock's trading at 20. So we could immediately buy the physical shares in the market at 20 and exercise our right to sell it at 25 and make $5. That makes the $5 the intrinsic value in this option. So if the put is currently trading at $5.95, then what you have is an option that is made up of 95 cents of time value that is decaying to 0 and that $5 of intrinsic value. And so it's important to be able to just simply differentiate that. So just to touch a few more little quick points on this, time value versus intrinsic value. Time value erodes. Think of it like your car insurance. Even though on an option, a probability time value doesn't decay in a linear fashion, sort of the way car insurance does, but think of it this way. If you bought car insurance on your car for a year and 6 months later you sell your car, you can ask the insurance company for a refund on the remaining 6 months of unused insurance. In the same way, if you bought 6-month option and 3 months later you sold it, you would have lost 3 months of time. The time would have decayed on the option, but there's 3 months left. So time value decays. And so time value erodes to 0 as the option approaches its expiration. Intrinsic value, on the other hand, is literally an equity stake in the stock. It is a physical stake into the ownership of the underlying, and it's important to anchor yourself on that. So intrinsic value is directly related to the value of the underlying security, right? And so if you look here, time decay, though, is not linear. There's an exponential factor to probabilities, which basically means that the fastest and most prevalent rate of decay, where your theta risk is greatest, is as you approach its expiration. It's the hockey stick bell curve, but pointed down towards 0. The exponential acceleration of your time decay occurs at the most rapid pace in the final 5 days of your option. So again, option expiration, so the third Friday of expiration, some stocks and ETFs have weekly options. So settlement value of the ETF options is based on the closing price of the stock at 4 p.m. So what are some other considerations? Option buyers pay a premium for the right to buy or sell the security at the strike price. This is valid for a specific period of time, and call options will expire worthless if the underlying is below the strike. So if I turned around and bought a call option on Tech Resources, for me to have the right to buy it at $30, the stock's at $26. I'm entering a contract on my belief that it's going not only to $30, but substantially higher than $30. So that call option, if let's say Tech Resources goes from $26 to $28 by expiration, but never surpasses $30, that option will expire worthless. And this is the world of speculators. And so when you see all the big disclaimers about the risks associated with options, these are the people that are using these options that have a relatively higher probability of expiring worthless, and the trader is speculating on being right about the direction of a stock. And if a speculation goes wrong, it could result in a loss. Well, if you're wrong, it will result in a loss. So the final thing, obviously, and quite the reciprocal, is a put option will expire worthless if the stock, underlying stock, is above the strike price. So put option tries to profit from the downwards motion in a stock, and therefore you're anticipating it to go lower, or you're buying protection from it going lower. And so the period from which an option gains value is during those drops. So I wanted to take the opportunity just very quickly before we get to questions. By the way, hopefully you'll stick around. We're going to open up the floor to question and answers here in just a moment. I'll be happy to stick around and answer any questions that any of you may have. But just very quickly, at the Montreal Exchange, we provide some amazing free resources. There's blogs from which I personally contribute to. There's investment option writing newsletters, all sorts of videos and webinars, guides and strategies. I know Scotia does a phenomenal job of providing top-notch education to all of their to their clients, but Montreal Exchange, seeks to give even further value for all of you on there. There's options calculators, there's trading simulators where you can paper trade these options, and there's also a program called Options Play, which allows you to create all sorts of different option strategies inside the simulator. And so all sorts of really amazing resources, and it's all complimentary. You're free to go on there and utilize all of these resources. So I'm going to invite Conliffe back online here, and he can guide the question and answer period here. Otherwise, just while he's coming online, I just wanted to thank all of you for spending the time with me, and I hope all of you got value out of today's session.
Excellent. Thank you so much, Patrick. That was quite the informative information, and I hope, as you said, that we did actually get some value from that. So I don't see any questions here at this point. Here we go. There is a question. Actually, there are two questions. Patrick, I had forwarded one over to you, but the first question had come from Nicholas. He indicates that you had spoken about the bid and ask. What about open interest? Is it similar to volumes in stocks? What is considered a liquid or an illiquid option?
Well, Nick, that's a good question, and thank you for asking that. So when you saw at the beginning, there was a contract that came into existence when a buyer and seller shook hands and agreed to do business, right? And so when the buyer and the seller exchanged it, it created 1 unit of open interest for every one call option or put option they opened. And so open interest is simply telling you how many of these contracts have come into existence. Now, open interest on an individual options chain, on an option line, is not as important as the open interest on the entire options chain, because if the entire options chain of all the different strikes are very liquid, then the market makers can facilitate tight spreads and liquidity in a marketplace, even if you don't see a very large open interest. What you want to think is that open interest is just telling you how many people have chosen that particular strike price to do business. Now, market makers are always offering a bid and ask, and so you can always see what the spreads are on a particular series. We do a whole session on understanding market makers and how the prices of options are determined. But generally, what you want to think of is that the more you're short-term in your nature, the more liquidity matters. So if you were swing trading and you were buying an option today, ready to flip it tomorrow, and your hold time is a short window of time, it would be relatively important to consider the most liquid options chain. Alternatively, if you have an investor that is taking a long-term stance and they buy a 6-month or 1-year option on their belief that some stock is about to make a material rise, the liquidity of the option is not important at all. Remember that once you've bought the option, if you feel that it was a fair price, you at some point in the future have the right to buy or sell the physical shares. And so the liquidity of the option for the long-term holding is quite irrelevant. And so you have to think that the liquidity matters the most for the different styles of trading. The more you're doing advanced combinations, the more you're doing spreads, the more you're doing short-term trading, the more important it is for you to stay with options chains that have a higher open interest and volume. If you're just an investor and you're using the option as an overlay tool, the liquidity is not remotely as important. I hope that answered the question.
Okay, great. Thank you, Mr. Patrick. I just have 2 other questions. Can you buy options repeatedly for the same company? And this is from Cloud.
Oh yeah, like in terms of overriding the day trading rules, I think that would be you. As far as I'm aware, you can quite freely buy and sell options in the marketplace on an ongoing basis. I don't know, Conliffe, if you have a different stance on that from the brokerage side, but as far as I know, there are no restrictions that way.
No restrictions. I mean, other than the volume issues, there's nothing else. You can buy them repeatedly, buy and sell, no problem. Cloud had a follow-up question on that. Could you use Tesla or Apple as an example? Does it make sense to get a stock option if you have a specific price you want to buy at? Is this a cheaper way to purchase Tesla or Apple stocks?
It's not a cheaper way. Remember, you're paying a time value premium, but there's a risk managed benefit to it. In other words, if let's say, for the sake of that example of Apple, let's say Apple's trading at $150, right? And you pay $2 for the call option for the right to buy it at $150. Well, don't forget your average cost base is going to be $152, not $150, because you paid $2 premium for buying the call option. So it is not cheaper that way. But what if Apple dropped and Apple went from $150 down to $140? Well, the investor who owned the shares would be down $10 a share, while the option buyer could only lose the $2 premium that they paid for the call. Now they might lose $2, but now they can buy Apple at $140, while the investor is down $10 per share. So there is a strategic benefit to the option. The strategic benefit is using it as a tool to risk manage your entries, but it's not cheaper to use the option to buy. It costs money to get that optionality in the trade.
Great, and it's 2 o'clock. It's past 2 o'clock, so we've passed the time. I'm just going to throw out this one last one to you, Patrick. I don't think we can answer it, but Furman is asking, please give us a list of index ETFs with options at the Montreal Exchange.
Oh, you can go right to the Montreal Exchange website and see that on the chains. But there is a very large amount of ETFs in Canada that have options on them. All the major high liquid ones do. The ETF market, options ETF market, has been increasingly growing in Canada. It's one of the highest growth areas for the Montreal Exchange. So there are increasingly large amounts of these ETFs out there. The specific list, you'd have to look it up. I can't just list it off for you, but it's just a matter of going to the Montreal Exchange site and exploring which ETFs and indexes they have those options on.
Perfect. Thank you so much, Patrick. Really appreciate that.
Well,
All right, so
thank you, Conleth, for having me, by the way.
Oh, you're very welcome. It was a pleasure there. At this point, then, we're going to just wrap up here. 2 more minutes, and then I'll put the presentation for you. To access the webinar recordings on our YouTube channel, you can either email us at education@scotiaitrade.com to request a copy, or you can go to the YouTube channel, Webinars on Demand playlist, to get a copy there as well. Now, after you exit the webinar session, we're going to provide you with a short survey, and basically, we just want to find out how we've done for this session today, myself and Patrick and Scotia iTRADE. As well, if you've got any other ideas about topics you want to have presented, you can also include that in the survey results. We do monitor those, and we'll try our best to accommodate you on that. So coming forward, there's going to be 2 webinars I'd like to provide to you here. ETFs 102. This is the second in the series of ETF information webinars. Fixed income ETFs, and that'll be Horizons ETFs Tuesday, August the 8th at 1 p.m. And then following that, on August 10th, the market guys will be providing a basic technical analysis webinar. So if you're looking for some fundamental information or some basic information for technical analysis, please go to the events calendar under the scotiaitrade.com education tab, events calendar, and register for those webinars or for any other webinars that you may see suitable there for you. So on behalf of Scotia iTRADE and the Client Education Department, I would like to thank Patrick for an amazing session, great information, and I would also like to thank you, our listeners, attendees, for taking some time out of your busy day to be with us today. We hope that the information presented helped, and that can help you to move forward to your investment goals. And we look forward to seeing you as we present further webinars going forward. So let me just take a couple of seconds here and upload the deck for your use. Bear with me 2 seconds. Options fundamentals. Another few more seconds and it'll be uploaded for you. Perfect. Now the deck is uploaded. So under the handouts menu in the GoToWebinar toolbar, just click on that and you can download the deck to your computer. I will send out a link, a recording link to all the clients that are all our attendees who've given us express consent. And then you can, if you don't receive it within, let's say, a couple hours, just email me at education@scotiaitrade.com and I'll be able to respond back to your email. Thank you so much. Have yourself a really great day, and we'll see you next time. Bye-bye.